You know, in a world with crazy high interest rates and markets that feel like a roller coaster, there's one area of finance that's being sold as this perfect calm oasis. It's called private credit. And the pitch is simple. You get great returns without all the heart-stopping volatility of the stock market. But what if that stability is just an illusion? What if the calm is just a lack of information? Well, in this explainer, we're going to pull back the curtain on one of the fastest growing and maybe one of the most misunderstood markets in the world. And this, right here, is the core of the issue. You've got two completely different stories being told. On one side, you have the big official institutions telling everyone, don't worry, it's all fine. But then on the other side, you have the actual data, the stuff that's bubbling up from the assets backing these loans, and it is telling a very different story. So we're going to follow that data right into the shadows. So here's how we're going to break it down. First, we'll look at why everyone thinks this market is so stable. Then we'll go inside these so-called shadow banks to see how they really work. We're going to uncover the accounting method that kind of manufactures this calm, and then we're going to really inspect the collateral for cracks. After that, we'll pinpoint the ticking time bombs, and finally, we'll wrap it all together with this one big idea, the volatility dam. Okay, so let's start with what you hear from the mainstream. If you listen to the big banks on their earnings calls or read the typical market report, the message is pretty consistent. Private credit is weathering the storm of higher interest rates beautifully. The whole narrative is all about resilience and strength. This is the phrase you hear over and over again, generally sound. The big players suggest that the companies they've lent to are just absorbing the higher costs, no problem, and that the foundation of the market is solid. And honestly, it's a really comforting story. On the surface, the performance charts look incredibly smooth and steady, but that's exactly where the comforting story ends and where our deep dive really begins. So to really get what's going on, we got to ask, what is private credit anyway? Well, it's pretty simple. It's just lending that happens outside of the normal, heavily regulated banking system. You see, after the 2008 financial crisis, a bunch of new rules made it way harder for banks to make riskier loans. But that risk, it didn't just vanish. It just moved. It migrated into this huge, fast-growing, and much less regulated space we now call the shadow banking system. And let's be super clear here, this is not some small niche corner of finance. This is a monster. By the end of 2025, private credit is expected to hit a massive $2.1 trillion. And this whole world operates far away from public stock exchanges, with way less transparency and fewer rules than the banks we all know. You know, this just completely debunks one of the biggest myths from the post-2008 world, this idea that the traditional banking system somehow got rid of all its risk. No way. The risk was just shoved next door, but the two houses are still connected by a giant systemic hallway. The regulated banks we use every day have something like $4.5 trillion of exposure to these shadow lenders, so the risk was never eliminated. It was just packed together, concentrated in a darker, much harder to see corner of the financial system. Okay, so if the risk is still there and maybe even more concentrated, why on earth does private credit look so smooth and stable? Well, the answer is kind of sneaky. It's all in how these assets are valued. It's a simple difference in accounting, but it changes everything about how we see risk. It's the secret sauce for manufacturing stability. So on one hand, you have mark-to-market. This is for stuff like public stocks and bonds. Every single day, the market screams out a price. It's transparent, it's instant, and yeah, it's volatile. But on the other hand, you have mark-to-model. This is the world of private credit. There is no daily price. Instead, the fund manager just uses their own internal model to estimate the value, and they only do it maybe once a quarter. That perceived stability, it's not a real feature of the investments. It's just a byproduct of the accounting. The lack of volatility is really just a lack of information. And believe it or not, this isn't some new trick. The legendary investor Benjamin Graham was writing about this exact thing decades ago. He knew there's this huge psychological comfort in not seeing your asset prices swing around every day. It lets you believe everything's okay, even if the fundamentals are actually getting worse. You don't panic because you can't see the price dropping. It's the ultimate financial version of ignorance is bliss. All right, so if the smooth-looking models are hiding the volatility, what else are they hiding? It's time to stop looking at the pretty graphs and start looking at the actual stuff that's backing these trillions of dollars in loans. Let's pop the hood and check the quality of the collateral. Now, if you ask the industry itself how things are going, you get a beautiful picture. They'll tell you that default rates are super low, somewhere between 1.8 and 2.2%. I mean, that sounds fantastic, right? Better than a lot of public markets. But then, and an independent agency like Fitch goes and digs into the same data, and they come back with a default rate that hit a record 9.2% just last year.
That is a massive difference. We're talking about a default rate that's more than 4 times higher than what the industry is reporting. One of these numbers is the truth, and the other one is just good marketing. And you guessed it, it gets worse. When one of these private loans actually does go bust, you get a lot less of your money back. Data from the Federal Reserve shows that with a typical big bank loan, lenders usually recover about 52 cents for every dollar, but with private credit loans, it's only 33 cents. And why is that? Well, because these loans are often backed by squishier collateral. Just think about it. It's a lot easier to seize and sell a factory than it is to sell the idea of a software company's future profits.
And that brings us to a really new, very modern risk. A giant slice of these private credit portfolios, we're talking about 30%, are loans made to software as a service companies, SaaS companies. The collateral backing those loans is basically the value of their monthly subscriptions. But what happens when generative AI causes a SaaS apocalypse? When a new AI tool can do the same job for practically free, what happens to that software company's value? The collateral that's backing hundreds of billions of dollars in loans could just, poof, evaporate.
So we've got fuzzy accounting and collateral that might not be as solid as it looks. Now let's zoom out and look at 2 huge systemic cracks that are starting to spread across the entire private credit world. These, my friends, are the ticking time bombs. To get the first-time bomb, you have to rewind the clock. Remember March 2007, right before the big financial crisis? Bear Stearns admitted it had problems in 2 of its hedge funds. By June, they slammed the gates and froze investor withdrawals. By July, those funds were totally bankrupt. It was a classic liquidity crisis. They promised investors they could get their money out fast, but they were holding assets that were impossible to sell fast. That was the canary in the coal mine for the whole system. And look, this isn't just some history lesson. It is happening again right now. These private credit funds promise investors they can take out a chunk of their money every quarter. But when too many people rush for the exit at once, the fund just can't sell its long-term loans fast enough to pay them. Just look at these recent headlines. BlackRock, Morgan Stanley, Blue Owl. These are the biggest names in the business, and they've all been forced to gate withdrawals, basically telling investors, sorry, you can't have your money back right now. The easy cash access they promised? It was a mirage, and now investors are tracked.
Now for time bomb number 2. It's something the entire financial world has its eyes on, the maturity wall. We're talking about a mind-boggling $1.8 trillion of debt that's all coming due in the next couple of years. This is debt that has to be paid back, or what's more likely, refinanced into a new loan.
And this is the trap. So many of these loans were made back when interest rates were basically zero. Now, all these companies have to go out and get new loans at rates of 5.5% or even higher. For thousands of so-called zombie companies, these are firms that don't even make enough money to cover their current interest payments. This is, as one analyst put it, a mathematical impossibility. It's hard to see how this doesn't end in a massive wave of defaults. So how do we pull all of this together? The shady accounting, the questionable collateral, the frozen funds, the coming maturity wall. Well, the best way to think about the entire private credit market is to picture it as a giant dam. This system is a volatility dam. Its whole job is to hold back the daily waves of market ups and downs. And from the outside, it creates this beautiful, calm lake that investors absolutely love. But what you can't see is that behind that thick concrete wall, the pressure from decaying assets, from crushing interest rates, from people desperately trying to get their cash out, that pressure is building, silently. And it's reaching a breaking point. And all of this leaves us with one final and really critical question. This whole structure was built to make investors feel safe by protecting them from volatility. But see, volatility isn't the risk itself. Volatility is just the symptom of risk. And by suppressing the symptom, the system has allowed the actual disease to grow unchecked. So the real question isn't if this dam is going to break, it's when, and what's going to be left standing in the flood.